There's a pattern in market history that has made certain investors extraordinarily wealthy during every major crash in the last 100 years. Not lucky, not insider trading. Wealthy because they understood a sequence that repeats every single time markets collapse. In 1929, while 90% of investors were wiped out, a small group made fortunes buying assets at 10 cents on the dollar. In 2008, while the average portfolio lost 50%, specific investors doubled and tripled their wealth in 18 months. And right now, in 2025, every indicator that preceded those crashes is flashing red. Market valuations at historic highs, debt levels unprecedented, confidence extreme. The setup is identical, and if the pattern holds, we're 12 to 18 months from a crash that will destroy unprepared portfolios and create generational wealth for those who understand the playbook. This isn't about predicting the exact date. This is about recognizing the 5-stage sequence that plays out before, during, and after every major market collapse. And more importantly, the specific moves that turn crashes into profit opportunities. Let me show you the pattern, the 5 stages that repeat every time, the exact positions that made investors wealthy in previous crashes, and why the window to prepare is closing faster than most people realize. Before we go through the stages, you need to understand what a market crash actually is and why it creates asymmetric opportunity. A crash isn't just prices falling. It's a psychological break where fear overwhelms greed, where selling becomes panic, where assets get dumped regardless of fundamental value. In normal markets, prices reflect some relationship to earnings, to cash flow, to underlying value. In crashes, that relationship breaks. Companies worth $50 per share trade at $15. Real estate worth $500,000 sells for $200,000. Bonds issued by solvent entities trade at 60 cents on the dollar. This happens because liquidity disappears. Everyone wants to sell. Almost no one wants to buy. And in that moment, the investors with cash and courage can acquire assets at prices that will never be available again. But here's what most people miss. The opportunity isn't random. It follows a precise sequence. And the investors who profit aren't guessing. They're following a playbook that's worked in 1929, 1987, 2000, 2008, and will work again in 2026. This is stage 1. Recognize the setup before the crash. Every major crash in the last century has been preceded by the same conditions. Extreme valuations. Markets trading at price-to-earnings ratios above historical averages. In 1929, stocks were at 30 times earnings. In 2000, tech stocks were at 100 times earnings. In 2007, real estate was priced assuming perpetual appreciation. Right now, in 2025, the market is trading at 28 times earnings. That's the second highest valuation in 100 years. Only 2000 was higher. Extreme leverage. Investors borrowing to buy assets, amplifying gains on the way up and losses on the way down. In 1929, margin debt was 10% of market capitalization. In 2007, mortgage debt was 100% of home values. Right now, margin debt is at record levels. Corporate debt is 50% of GDP. Consumer debt is 80% of GDP. The system is leveraged to a degree that makes it fragile. Extreme confidence. When everyone believes markets only go up, when fear has disappeared, when skepticism is mocked, that's the top. In 1929, economists declared the end of the business cycle. In 2007, real estate professionals said home prices never fall nationally. Right now, financial media discusses soft landings and continued growth as certainties. The confidence is extreme. These 3 conditions, high valuations, high leverage, high confidence, they create fragility. And when fragility meets a trigger, crashes happen fast. The trigger can be anything. In 1929, it was margin calls. In 2008, it was subprime mortgage defaults. In 2026, it could be corporate debt defaults, a geopolitical shock, or a credit freeze. The specific trigger doesn't matter. What matters is recognizing the setup. And the setup is complete right now. Stage 2. Position before the crash. This is where most investors fail. They see the warning signs but do nothing because markets keep rising. They think they'll have time to react when the crash starts. They won't. Crashes happen in days or weeks, not months. By the time it's obvious, it's too late to position. The investors who profited in previous crashes positioned 6 to 18 months before the collapse. They moved to cash. They sold overvalued assets. They bought insurance. Let me show you the specific positions that worked. Cash and short-term treasuries. In every crash, cash becomes the most valuable asset because it's the only thing people want. In 1929, investors who held cash could buy stocks at 90% discounts. In 2008, cash holders bought real estate at 50% off. Right now, the average investor holds 2% cash. That's the lowest level in 20 years. Everyone is fully invested because they fear missing gains. This is exactly wrong. The investors who profit in crashes hold 30 to 50% cash going into the collapse. They sacrifice the last 10% of gains to have ammunition when prices crater, short positions or put options. This is more aggressive, but it's how some investors made 500% returns in 2008, shorting overvalued stocks or buying put options that increase in value as markets fall. This requires timing and risk management. But in 1929, investors who shorted at the peak made fortunes. In 2000, investors who shorted tech stocks made 300% as the bubble burst. In 2008, investors who bought puts on financial stocks made 1,000% in some cases. Right now, the cost of portfolio insurance is historically low. Put options are cheap because confidence is high. This is the time to buy insurance, not when the crash starts. Gold and hard assets. In every crash, some investors flee to tangible assets. Gold typically falls initially as everything gets sold, but then rallies as currency concerns emerge. In 1929, gold was fixed in price, but after the crash, it was revalued higher. In 2008, gold fell from 1,000 to 700, then rallied to 1,900 by 2011. The investors who bought gold during the crash made 170%. Right now, gold is at all-time highs, which seems counterintuitive. But the pattern says gold often peaks before crashes, pulls back during the crash, then rallies in the aftermath. The play isn't gold at current prices, it's gold after the initial crash sell-off. These positions, cash, shorts, and hard assets, they feel wrong when markets are rising. They underperform, they make you look foolish, but they're the foundation of crash profits. Because when stage 3 hits, these positions become invaluable. Stage 3. Survive the crash without panic selling. This is the stage where most investors destroy themselves. Markets are falling 3, 5, 10% per day. Portfolio values are collapsing. Fear is overwhelming. And the instinct is to sell everything to stop the pain. This instinct is fatal. The investors who profit in crashes don't sell during the panic. They hold their cash positions and wait. They hold their short positions and take profits. And critically, they don't sell quality assets at crash prices. In 1929, investors who panicked sold at the bottom locked in 90% losses. Those stocks took 25 years to recover. In 2008, investors who sold in March 2009 at the bottom missed the entire recovery. The market doubled in the next 18 months. The pattern is consistent. Crashes create panic. Panic creates selling. Selling creates lower prices. Lower prices create more panic. This feedback loop continues until everyone who can sell has sold. That's the bottom. And the bottom is where the opportunity appears. But you can't take advantage if you've already sold. The investors who profited in previous crashes had the psychological strength to hold cash while their neighbors were panicking. They watched portfolios fall 50, 60, 70% and didn't sell. They waited. This requires preparation. You need to have positioned before the crash so you're not forced to sell. You need to have cash so you're not liquidating at the bottom. You need to have conviction that the pattern will play out, because in the moment, it feels like the world is ending. In 1929, people believed capitalism had failed. In 2008, people believed the financial system would collapse. The fear is real. The panic is justified. But the pattern says markets always recover. And the investors who understand this can act when others are paralyzed. Stage 4. Deploy capital at maximum fear. This is where fortunes are made. When fear is at its peak, when everyone believes markets will fall forever, when selling is panic and indiscriminate, that's when you buy. Not before, not after. At maximum fear. How do you identify maximum fear? The signals are consistent across every crash. Capitulation volume. Trading volume spikes to levels 5 to 10 times normal as everyone sells at once. In 1929, October 29th had volume of 16 million shares, triple the previous record. In 2008, October 10th had volume of 11 billion shares, double normal levels. When you see volume spike like this, you're near the bottom. Valuation extremes. Price-to-earnings ratios fall below 10. Dividend yields rise above 5%. Assets trade below book value. In 1932, stocks traded at 5 times earnings. In 2009, stocks traded at 11 times earnings. When valuations reach these extremes, you're at or near the bottom. Media capitulation. When financial media declares the end of markets, when covers of magazines show despair, when experts predict decades of decline, that's the bottom. In 1929, headlines said, "End of capitalism." In 2009, headlines said, "The Great Depression 2.0." When media capitulates, the bottom is close. At this point, the investors who positioned correctly deploy capital aggressively. They buy quality assets at absurd discounts. In 1932, you could buy blue-chip stocks at 10% of their 1929 prices. Companies with real earnings, real assets, real businesses trading for nothing. Investors who bought at the bottom made 500% by 1937. In 2009, you could buy bank stocks at 80% discounts, real estate at 50% off, corporate bonds at 60 cents on the dollar. Investors who bought in March 2009 made 200% by 2011. The pattern is identical. Maximum fear creates maximum opportunity, but only for those who have cash and courage. If you're watching this and you're starting to understand that market crashes aren't random disasters but predictable sequences with specific profit opportunities, then you're seeing what most investors miss. The pattern repeats because human psychology doesn't change. Fear and greed drive the same behaviors in every generation. Subscribe to Economy Time Machine because we're going to track the setup in real time, show you the signals as they appear, and help you position before the crash happens. Because the window is closing, the setup is complete, and Stage 5 is where the real wealth is built. Stage 5. Hold through the recovery and compound gains. This is the final stage, and it's where discipline matters most. After you buy at maximum fear, after you acquire assets at crash prices, the temptation is to sell quickly for a 20 or 30% gain. This is a mistake. The real wealth is made by holding through the full recovery cycle. In 1932, if you bought at the bottom and sold in 1933 for a 50% gain, you missed the 400% gain by 1937. In 2009, if you bought at the bottom and sold in 2010 for a 60% gain, you missed the 300% gain by 2013. The pattern says crashes are followed by multi-year recoveries, and the assets you buy at crash prices will return to fair value and often exceed it. This requires patience. Markets don't recover in straight lines. There are rallies and pullbacks. There are moments of doubt. But the investors who hold quality assets bought at crash prices for 3 to 5 years make generational wealth. Let me show you the specific returns. In 1929, the market peaked at 380. By 1932, it had fallen to 40. That's a 90% decline. Investors who bought at 40 and held to 1937 made 400%. By 1954, the market exceeded the 1929 peak. Investors who bought at the bottom and held 22 years made 850%. In 2000, tech stocks crashed 80%. Investors who bought quality tech companies at the bottom and held to 2010 made 500%. In 2008, the market fell 57%. Investors who bought at the bottom in March 2009 and held to 2013 made 180%. By 2020, they'd made 400%. The pattern is consistent. Buy at maximum fear, hold through recovery, Compound gains over years. This is how crashes create wealth. Now let me show you why 2026 is the likely timeline. Market cycles average 7 to 10 years from bottom to bottom. The last bottom was March 2009. We're 16 years into this cycle. That's the second longest expansion in history. Only the 1990s expansion was longer, and it ended in a massive crash. Debt cycles peak when interest payments consume too much income. Right now, corporate interest payments are approaching 30% of earnings. Consumer debt service is 15% of income. These are levels that preceded previous crashes. Credit cycles turn when defaults rise. Right now, corporate defaults are increasing. Consumer delinquencies are rising. Credit card defaults are at 5-year highs. The credit cycle is turning. Valuation cycles peak when prices disconnect from fundamentals. Right now, we're at the second highest valuation in 100 years. The only time it was higher was 2000, right before a 50% crash. The timeline says 12 to 18 months. Not because of a specific prediction, but because the conditions that precede crashes are present, and historically, crashes follow these conditions within 12 to 18 months. Maybe it's sooner, maybe it's later, but the setup is complete. Here's what this means practically. Right now, you should be moving to cash, not all at once, not in a panic, but systematically reducing exposure to overvalued assets and building cash positions. The target is 30 to 50% cash by mid-2026. You should be identifying the assets you want to buy at crash prices. Quality companies with real earnings. Real estate in strong markets. Bonds from solvent issuers. Make a list now so you're not deciding during the panic. You should be buying portfolio insurance. Put options on major indices. Inverse ETFs. Gold positions. The cost is low now. It will be expensive or unavailable during the crash. You should be preparing psychologically. Crashes are terrifying, even when you expect them, even when you're positioned correctly. The fear is real. Prepare yourself now so you can act when others panic. The investors who profit from crashes aren't smarter. They're prepared. They understand the pattern. They position before the crash. They hold through the panic. They buy at maximum fear. They hold through recovery. This 5-stage sequence has created wealth in every major crash for 100 years, and it will work again in 2026. Let me show you the specific numbers. If you hold 40% cash going into a 50% crash, and you deploy that cash at the bottom, and the market recovers 100% over 3 years, your return is 80% while the average investor breaks even. If you buy put options that increase 300% during the crash, and you use those profits to buy assets at the bottom, your return is 200% while the average investor loses 50%. If you buy quality stocks at 50% discounts and hold for 5 years through recovery, your return is 300% while the average investor makes 50%. The math is simple. Crashes transfer wealth from the unprepared to the prepared, from the emotional to the disciplined, from those who follow the crowd to those who understand the pattern. The 2026 crash, if it happens on the timeline the pattern suggests, will be the greatest wealth transfer opportunity of your lifetime because the setup is more extreme than 2008. The valuations are higher, the debt is larger, the confidence is greater. When it breaks, it will break hard, and the opportunities will be extraordinary. 3 times in the last 100 years, major market crashes have followed this exact pattern. 1929, 2000, 2008. Each time, the setup was obvious in hindsight. Each time, most investors were caught unprepared. Each time, a small group who understood the pattern made fortunes. The conditions are present right now. Extreme valuations, extreme leverage, extreme confidence. The setup is complete. The timeline says 12 to 18 months, and the 5-stage playbook is ready. Stage 1, recognize the setup. Check. We're here now. Stage 2, position before the crash. This is the current window. Stage 3, survive without panic selling. This requires preparation now. Stage 4, deploy at maximum fear. This is where fortunes are made. Stage 5, hold through recovery. This is where wealth compounds. The pattern doesn't guarantee the exact timing, but it shows the sequence, and the sequence is starting. If this changed how you see the current market, if you understand now that crashes aren't disasters but opportunities for those who prepare, if you recognize the pattern forming right now, then you're positioned to profit while others panic. Subscribe to Economy Time Machine because we're going to track every stage as it unfolds, show you the signals in real time, and help you execute the playbook that's created wealth in every crash for a century. The setup is complete. The window to position is open but closing. And when the crash comes, the only question will be whether you prepared or whether you panicked. The pattern says 2026. The playbook is proven, and the opportunity is coming. The investors who understand this will build generational wealth. Those who don't will watch their portfolios collapse and wonder why they didn't see it coming. The pattern was always there. You just had to know where to look.